Dear students, welcome to our channel. In this video, let us discuss few practical problems in the Accounting for Partnership Firms Fundamentals Chapter 1 for CBSE Class 12 Accountancy. In our previous video, we discussed few basic concepts. I have given the link of that previous video in the description. You can have a glance over that video. Now let us start discussing few basic problems in this chapter. Now we will discuss about few problems in accounting for partnership firms. Firstly, we are given with a question of Mr. A and B started the business with the capitals of 3 lakhs and 2 lakhs, and we are given with some other details also. Whenever we solve a problem in a accountancy subject, first divide the question into small hints. This will better help you to navigate the solution. So A and B are with the capitals of 3 lakh and 2 lakhs. Mr. B is to get a salary of 5,000 per month, and Mr. A has to get a commission of 10% on profit after allowing salary to Mr. B. And the firm is going to make an interest on capital at the rate of 6%. Interest on capital we discussed earlier, it is an income for the partners and it is an expense for the firm, partnership firm. Profit sharing ratio is 3:2. And one partner, Mr. A, gave loan to the firm at an interest of 8% per annum. And then for the another person, Mr. B, he was given loan by the firm and again 8% interest. The manager was allowed a commission of rupees. The manager's commission is rupees 3,000, and profit before all these adjustments. The profit before these adjustments was rupees 2,50,000. We are asked to pass necessary journal entries and prepare the profit or loss appropriation account. So two parts of this question. One is passing of journal entries. The other one is the preparation of a profit or loss appropriation account. Before starting to pass the journal entries, we have to work out a small additional information, working notes, to find out the available divisible profits for partners. And in the question it is given that one partner gave loan to the firm, the other partner was given loan by the firm. That is, Mr. A gave loan to the firm. In this case, the interest is payable by the firm to the partner. It is the amount of loan is 1 lakh. The amount of loan is 1 lakh at an interest rate of 8%. So it is rupees 8,000. In the next case, Mr. B partner was given a loan. That is, the firm has given a loan. So interest is receivable by the firm. It is amount is 2 lakhs, and this partner was given the loan on 1st of October. So the interest will be proportionated for 6 months, that is rupees 8,000. Two cases. One case the firm receives the interest, the other case the firm pays the interest. And in the question we are given with profit before all these adjustment. Profit before all these adjustments is counting to 2,50,000, and we will add the interest receivable from the partner B. Interest receivable, because the firm has given the loan to this partner. Then other cases, interest payable to Mr. A, the partner to who this partner Mr. A has given the loan to the firm. So the firm will pay interest. There is one more component, that is the manager's commission. Manager's commission, it is rupees 3,000, the manager's commission. Adding and subtracting all these things from the above profits, it is 2,47,000. This is the divisible profits available for the partners. Now, once the divisible profit is estimated, this is to be transferred from profit or loss, from the normal profit or loss account. So we prepare the journal entries, transferring the first entry is transferring the available profits from the profit or loss account to profit or loss appropriation. Profit or loss appropriation account. It is divisible profits that are transferred from the normal profit or loss account to profit or loss account to profit or loss appropriation account. Then next is the partner B is entitled for a salary, and it is to be any partner who is to receive money from the business. His account, he will be receiving the money through his capital account. So Mr. B is entitled for a salary payable to Mr. B. All the journals should be supported by the adequate narration. Narration writing is very important. And this partner gets a salary of rupees 5,000 per month. So for 12 months he is entitled for a salary of 60,000 rupees. Mr. B is to get a salary of 60,000 rupees. Then another partner, Mr. A, he is entitled for a commission. So A's commission account, he is entitled for a commission. So, and he will also receive, partner who are receiving the money, they will receive through their capital account. That is, their capital account is to be credited, being commission payable to Mr. A. And here it is given in the question that this commission he will receive from the profits after giving the salary to Mr. B. So Mr. B's salary will be deducted from the profit. So it is rupees 1,90,000, and in this he will be getting 10%. That is, it accounts to 19,000. So these two are expenses for the firm, these two components, and they are distributed to the partners through profit or loss appropriation account. So profit or loss appropriation account to A's commission, and to A's commission account, and to Mr. B's salary account. B's salary account. These two are the commitments, that is the transfer of money to the partners, being salary and commission transfer. It is, commission is transferred to the extent of commission. A is going to get a commission of 19,000 and B is to get a salary of 60,000. So totally 79,000 is the total money the firm has to pay to the partners. The next component is the interest on capital. Interest on capital account data. Two partners will receive this through their capital account to A's capital, and A has given a capital of 3 lakhs. In this 3 lakhs he will get 6% as interest. So his interest on capital is 18,000, and the next partner to B's capital rupees 2 lakhs, and he will be getting an interest of 6%, that is 12,000. So these are the incomes for the partner, and this will be being interest on capital payable to partners, and totally for the firms it is a commitment to the extent of 30,000. It is the money payable by the firm, and this money would be transferred through any distribution to the partners. It will be done through the profit or loss appropriation account. So profit or loss appropriation account data to interest on capital account. Interest on capital account being interest on capital transferred. Interest on capital transferred. It is the firm pays 30,000 as interest on capital. So all the set points are noted. The last entry is for transferring the profit share to the partners, that to be arrived after preparation of the profit or loss appropriation. Profit or loss appropriation account, and we have estimated that the available divisible profits is for 1,47,000, which we have transferred from the normal profit or loss account. So 2,47,000 and to A's capital account. Transfer is for commission. A's transfer capital for commission. It is 19,000 A has to get, and B's capital account, he will receive a salary of rupees 60,000, and then A's capital, again he will receive for interest on capital. For space reasons I am writing it in short, 18,000, and B's capital account, interest on capital, he will be receiving an interest on capital of 12,000. So after noting down all these capital salary, the profit or loss appropriation account is to be balanced by adding and deducting the totals on both the sides. So the difference amount happens to be 1,38,000. This is the profits available for the partners, and it will be transferred in the ratio given in the question, 3:2 ratio. The profits are transferred. So A's capital account and B's capital account, A's capital account and B's capital account. For A it would be 88,800, and for B it is 55,200. So finally the available profits are distributed to the partners, and this is to be recorded in the journal. So profit or loss appropriation, account data to A's capital account and to B's capital account. The amounts are, for A it is 82,500 and for B it is 55,200, totaling 1,38,000, being profits transferred to partners. So we have worked out the journal entries and also the profit or loss appropriation account. Now second question. M and N are partners with the capitals of 6 lakhs and 2 lakhs, and we are given with some more details. So as usual, what we will do is we will start solving the question by breaking down the question details into a small hints. Here M and N are partners, and their capitals are 6 lakhs and 2 lakhs respectively, and it is given that their net profit before adjustments, net profit before partnership deed, was rupees 2,40,000. Net profit before all these adjustments was rupees 2,40,000, and the salary to one partner is given as, salary for one partner is given as 60,000 per annum, and again the interest on capitals, it is given in amount. We need not calculate as a percentage in the as we did in the previous question, and drawings amount is also given. Drawings of the partners are 60,000 and 40,000, and interest, again all the details it is given in the amount, and interest on drawings it is given in the amount, not as a percentage. Here in this question we are asked to show the profit distributed, how it will be distributed to the partners. when the capitals are fixed and the capitals are fluctuating. We had enough discussion about what is a fixed and fluctuating capital. So we will start solving the question. First is we will start working for when capitals are fixed. Whenever the capitals are fixed, it will be done on the, when the capitals are fixed, it will be two accounts we will be maintaining. One is the capital account, the other one is the current account. Before preparing that, we will make the profit or loss appropriation account. In the question, we are given with the profits before all these adjustments, that is profit or loss account. It is given in the question as 2,40,000, and we are given with the interest on capital. Directly the amount is being given and we transfer it to the partner's current account. When we maintain, now we are attempting to prepare the accounts based on the fixed capital method. So two accounts are to be prepared. One is the capital account, the other one is the current account. So the interest on capital is transferred to the current account. For M it is 36,000 and for N it is 12,000. It works out to 48,000. Amount are given directly in the question. And salary to a partner. N's salary, it is for 60,000 and he will receive this through current account. You can also write it as a current account for the reason of salary. Then interest on drawings, it is an income for the firm. Interest on drawings, it is an income for the firm. Interest on drawings, two partners will receive this. Two partners will receive this through their current account. So M current account and N current account, and it is the amount is given in this question. We need not calculate as a percentage. The amounts are readily given. So the company receives as an income of 3,000 by the way of interest on drawings. So now almost all the partner sharing are noted down. So we total the credit side and we balance for the debit side. It is 2,43,000. So the available balance, that is debit side, is a shortage of 1,35,000, and this is the profits to be transferred. This question is silent about the profit sharing ratio. So when nothing is given about the profit sharing, we will divide the available profits in the equal ratio. So profit is divided in the equal. It is 67,500 and 67,500. So it works out to 1,35,000. So we have prepared the profit or loss appropriation account under the fixed capital method when capitals are fixed. And now under fixed capital method, we will be preparing two accounts. One is the capital account. First is balance carried down. We are given with the balance carried down. It is to the extent of 6 lakhs and 2 lakhs for the partners. And only this entry will be available. Here there is no introduction of additional capital, nothing. So only one entry to be recorded in the capital account, and this entry becomes the closing entry also. It is to balance carried down, and the same amounts 6 lakhs and 2 lakhs. And current account, it is where the partners receive and give the interest on capital and interest on drawings, all these things. So firstly for two partners, here also it is for partner M and partner N. We prepare it in the single table M and N. Two partners M and N. Here firstly it is for interest on capital by interest on capital. It is given in the question as an amount 36,000 and 12,000. Then by profit or loss appropriation account. This is the profit share for the profit or loss appropriation profit or loss appropriation account. This is for the profit or loss transfer. It is 67,500 and 67,500. And one more partner, Mr. N, will be getting a salary. N's salary. So it is also from P&L to N's salary. He is getting it through the P&L appropriation account. It is 60,000. Now on the debit side, we have drawings. Drawings is the money taken by the partners for their personal use, and after some period of time it will be returned to the firm along with the interest for the duration. And interest on drawings. Interest on drawings is an expense for the partners and it is an income for the company, and it is 2,000 for the case of M and it is 1,000 for the partner N. Then the difference amount on the debit side. Now almost all the entries relating to partners transfer are made. So the difference amount is balance carried down. It is 41,500 and it is the difference amount is 98,500. We balance the current account, the difference amount, by totaling by making the total. Here when you total it and find out the difference, you will get these values and they are transferred to the partners current account. 1,03,500 and 1,39,500 current account. Now we have completed the calculation for the profit or loss account, capital account, current account through fixed capital. Now we will be proceeding to prepare the same when the capitals are based on fluctuating method. For the purpose of time saving, I copy down the same what we have did in the fixed. Now we will make it for fluctuating. It will be a time saving process, but anyhow in the exams you have to prepare 2 times when the capitals are fluctuating. The things that you have to do is, in case of fluctuating, only one account will be prepared, that is capital account. There is nothing called current account in the fluctuating capital method. So you will be making the entries wherever that is current account is to capital accounts. There is nothing called current account in the fluctuating method. So everything will be to the capital account. All the profit sharing, all things will be transferred to capital account. Every transfer will be made to capital account. For time saving purpose, what I do is I just alter the profit or loss appropriation, and you can also better understand what is the changes that has to be done. So we have prepared the profit or loss appropriation account. And then another thing is the current account, what we made in the under the fixed capital method, and there is nothing called current account. So it will be capital accounts only. In the fluctuating method, you have to include the original capital by capital account, the original balance carried down, balance brought down, the original balance brought down, that is the capital, the total capital of the partners. It is 6 lakhs and it is 2 lakhs. All other things remain same. All other entries remain same. One thing, it is for time saving purpose, I have just copied the same format. The other thing is you could also better understand what are all the changes happening. So it is 6,41,000 the difference amount, and it is 2,98,000. The totals are 7,03,500 and it is 3,39,000. It is 7,03,500 and here it is 3,39,500. Yes. So we have made the journal entries and profit or loss appropriation account based on fixed capital and fluctuating capital methods. Now starting the third question, we are given with the details about 2 partners and breaking down the given question into hints. Mr. P and Q are partners, and Mr. P, one partner, Mr. P, is to get a salary of 30,000 per month and a commission of 10%, and Q is getting a salary and he is also entitled for a commission. The point to be noted is P's salary is given in terms of per month and his commission he is being given a commission before charging any commission. Whereas salary for Mr. Q is given on annual basis and his commission payable is on after charging all these commissions. And again, we are not given with the available profit, total earnings of the firm. So the profits are after partner salary but before commission. So we have to prepare a small working note and then arrive the available divisible profits as we did in the first question. So firstly, we will prepare a working note to find out the available divisible profits for partners. Available divisible profits for the partners. In the question, we are given with the profits after partner's salary, but that is the profit is given after deducting the salary for the partners, but before the commission that is payable to them. That value it is given as 5 lakh rupees, 5,50,000. Now what we will do is we will add back the add back the salaries of the partners. So first is P is salary. This partner has received the salary rupees 30,000 per month. 30,000 per month for 12 months. For 12 months he would have received rupees 3,60,000. This has been already adjusted. And another partner, for him the salary is given Q's salary. For him the salary is given for the annual value per annum. It is given as rupees 50,000. After deducting these two salaries only, they have given the profits. So in order to get the available profits, available divisible profits, we add this and we arrive it as 9,60,000. This is the available divisible profits for partners. This is the available divisible profits for the partner. And after knowing this, we will prepare the, after estimating this, we are going to prepare the profit or loss appropriation account. As we know, once we estimate the available divisible profit, it will be transferred from the normal profit or loss account. It is 9,60,000 and the partners will get a credit of their salary and commission through their capital account. The first partner, P's capital account. This is for giving him the credit of salary, and it is, we have already estimated 30,000 into 12 months. He is getting a salary of rupees 3,60,000. The next person getting a credit, Q's capital account, and this person is also getting this for the reason of salary, whereas here the amount is given for the annual value as an annual value. The next credit for the P, partner P's capital account, is the commission. This person is going to get the commission, and here it is given that Mr. P is going to get a commission before charging. So the overall available profit 9,60,000, and he is going to get a commission before charging. That means it is charged as 10%. It is given in 10%. This person is entitled for before charging any commission. Before commission payable to any other partner, this person is going to get. So it is directly 10% on the available profits. Whereas this person, the next partner, to Q's capital, this person is also entitled for a commission, but here the differentiating point of Q from Mr. P is he is going to get a commission after charging any commission. What is that after charging any commission? The available profit is 9,60,000 for the partners. The available profit is, and in that one commission of 96,000 was given to Q. So from this this will be deducted. That is from 9,60,000 minus of 96,000. So it is 8,64,000. And from this, since it is the wordings is given as after charging such an commission, that means of this rupees 8,64,000. It is to be calculated as 8 divided by 108. You add the percentage of commission to the 100 in the denominator. This is for the reason the wordings as given as after charging such an commission. Whenever you read this word after charging, add that percentage to the denominator 100 and then calculate. So it works out to rupees 64,000. So we have made all the entries regarding to salary and commission. Now the profit or loss appropriation account is to be balanced. It is 9,60,000, the only entry in the credit side, and when we balance it, the difference amount works out to 3,90,000, and to profits transferred, equal transfer. The question is silent about the ratio. Whenever there are no ratio is available, the partners' profits will be shared equally, and they will get a credit in their capital account, P's capital account. When you divide this 3,90,000, it will be 1,95,000. And again, Mr. Q's capital, and he will get a credit of 1,95,000. So we have made all the given entries and prepared the P&L appropriation account, that totaling to 9,60,000. Now fourth question. X and Y are partners sharing in profits and losses in the ratio of 2:3 with the capitals of 2 lakhs and 1 lakh. We are asked to pass necessary journal entries for 6 different cases. Here we are not going to break down the question because the question itself is given into subheadings. So firstly, if partnership deed does not provide interest on capital, that means there is no division of profit. The entire profit given in the question is the available divisible profits. So it is transferred from the normal profit or loss account to profit or loss appropriation account. Profit or loss appropriation account being profits transferred to P&L appropriation account. P&L appropriation account. The available profits are transferred from the normal profit or loss account to P&L appropriation account. It is amounting to 20,000. It is given in the question, 20,000. And this is the profit that is to be divisible, that is to be shared between the partners. So profit or loss appropriation account data, that is the profit that is divisible to the partners. Whatever the partners are entitled to get it from the firm, they will get as a credit in their capital account. So X capital account to Y capital account. And it is given in the question that the profit sharing ratio being profits shared in the ratio of shared in 2:3 ratio. The profits are shared in the ratio of 2:3. That is, the 20,000 is divided in 2:3. Hope you will be familiar in dividing the values. So this is the journal for the first case. The second case, if the partnership deed provides an interest on capital 6% and there is a loss for the year. In this situation, in the second situation, it is a loss. So since it is a loss, there is no available profit to distribute. And whenever there is a loss, the loss is transferred from the normal profit or loss account to the appropriation account, P&L appropriation account. That is, it would be debited in the P&L appropriation account to profit or loss account. From the normal profit or loss account, it will be debited to the P&L appropriation account, being loss transferred to P&L appropriation account. That is 15,000 and 15,000. Now this loss is to be shared by the partners, that is X capital. When they share the profit, they are also entitled to share the loss. So X capital and Y capital. When it is a profit situation, partners get a credit of the profit. When it is a loss situation, it is the partners account, the capital account is to be credited. Profit or loss appropriation profit or loss appropriation account. In case of profits, it would be credited, and in case of loss, it would be debited, being loss shared by partners in 3:2 ratio. Sorry, in 2:3 ratio. In 2:3 ratio. And this 15,000 when divided in 2:3, it comes to 6,000, 9,000, and here it is 15,000. These are the journal entries for the second situation. Now, the third situation is the partnership deed provides an interest on capital of 6%, and there is an available divisible profit of 21,000. So, whenever there is a profit, firstly, it would be transferred from the normal profit or loss account to the profit or loss appropriation account. Profit or loss appropriation account. It is the profits being profits transferred from P&L account, being profits transferred to P&L appropriation account. Yes, the amount of profit given in the question as 20, it is given as 21,000. And the next is about the interest on capital allowed. Interest on capital, as we discussed, interest on capital is an income for the partners and it is an expense for the company. So it is X capital. The partner X has contributed 2 lakhs as capital and the interest percentage is 6%. So he will be getting 12,000 as interest on capital, and partner Y to Y capital. Partner Y has contributed 1 lakh as capital and his 6% interest works out to 6,000. So totally it is 18,000. 18,000 is the interest on capital allowed, being interest on capital allowed to partners. The partners are entitled. Now it is distribution of this money to the partners. That is, it is done through profit or loss account. Profit or loss appropriation account data. Profit or loss appropriation account. Profit or loss appropriation account data to interest on capitals. Profit or loss appropriation to interest on capital, being interest on capital transferred. Interest on capital transferred, it is 18,000. Here in this question, the profits available as 21,000 and interest on capital is 18,000. So the available profit is 3,000 is to be shared between the partners. That is profit or loss appropriation account, profit or loss appropriation account data, and it is to be shared between the partners. That is X capital, they are getting a profit share, X capital account, and to Y capital account. Partner share the profits. It is being profits distributed to partners in the ratio of 2:3. It is rupees 21,000 was the available profit and interest on capital is 18,000. So rupees 3,000 would be distributed in the ratio of 2:3. That is, Mr. X is getting his share as 1,200 and Y is getting his share as 1,800. So totally the interest on capital is, the profits available for distribution is 3,000. Then the third situation is, if the partnership deed provides interest on capital has a charge on profit. Here it is given as a charge on the profit. That means firstly you have to deduct the interest on capital. Then only anything available, it is a compulsory commitment for the firm to be given to the partners. First it is to be deducted and then only you have to fix the amount available for distribution to the partners. So here the interest on capital, for the time saving purpose, I am copying the same journal entry what we have noted down in the previous case, just to save your time. The entry is going to be the same, interest on capital to X capital and to Y capital. It is 12,000, 6,000. Whereas since it is given as a charge, the interest on capital would be debited in the normal profit or loss account. Before any money taken to the P&L appropriation account, it will be debited in the normal profit or loss account. So profit or loss account data to interest on capital. Now the company is having a profit of 20,000, but 18,000 is already deducted for the interest on capital. Now the available divisible profits. So profit or loss appropriation account, profit or loss appropriation account. So sorry, profit or loss account. The normal profit or loss account has an amount, profit or loss account to profit or loss appropriation account. Appropriation account, it is only 2000 is available, being available profits transferred. That is, we had a profit of 20,000. And in this, a deduction of rupees 18,000 for interest on capital is done. So only 2,000 is available to be distributed to the partners. So it is transferred from the normal P&L account to profit or loss appropriation. And this money, again, it is transferred to the distributed between the partners. That is profit or loss appropriation, profit or loss appropriation account data to X capital account and to Y capital account. That is the available profits distributed, being profits distributed in 2:3 ratio. Profits distributed in 2:3 ratio. That is the 2,000 available profit in the ratio when it is distributed in 2:3, it works out to 8,000 and 1,200. These are the journal entries for the fourth case. The charge in profit means the interest on capital is to be fixed in the normal profit or loss account itself. After adjusting there, then only the available profits is to be transferred to normal profit or loss appropriation account. Then next case, if the partnership deed is provides for interest on capital at the rate of 6% per annum, and here also the situation is charge on profit. That means the interest on capital is to be fixed in the profit or loss stage itself, normal profit or loss account itself. So any of the entries, first two entries is going to be same as in the previous question. So I am just copying the journal entries for time saving purpose. Interest on capital is same and it is transferred to the P&L in the profit or loss. Whenever it is a charge, it should be the interest is to be adjusted in the normal profit or loss account. And here the profit is only 2,000 available, but the commitment for the firm is 18,000. So the firm suffers a loss of rupees 2,000. Whenever there is a loss, the profit or loss appropriation account, profit or loss appropriation account is to be debited. It is the loss is transferred from the normal profit or loss account, that is being loss transferred to P&L appropriation account. The term charge means even the company is not earning sufficient profits, it is to be credited in their capital accounts. And here then they will share the loss for the overall company. So here being loss transferred, the company had an interest commitment of 18,000, but whereas they had only 2,000 profit. So the remaining 16,000 is the loss for the firm. So this 16,000 loss is transferred from the normal P&L account to the profit or loss appropriation account. And this loss is to be shared by the partners. Whenever there is a profit, the partners will get a credit to their capital accounts. And whenever there is a loss, the partners' capital account will be debited to profit or loss appropriation account. In the profit case, the partners' capital account would be credited. In loss case, the partners' capital account would be debited, being loss shared by partners. Being loss shared by partners in 2:3 ratio. Loss shared by partners. So what is the amount of loss? It is 16,000, and when it is done, it is 6,400 and 9,600. So here the point to be noted is the charge on profit. Whenever there is a charge on profit, though you earn sufficient profit or not, it is to be fixed in the profit or loss account itself, normal profit or loss account itself. Then coming to the sixth case, the partnership deed provides interest on capital at 6% and profit for the year is 18,000. For the interest on capital, we will just make a copy of the same entries what we did in the previous case. So interest on capital 18,000 and 12,000, 6,000 is the partner's credit. Here profit or loss account, interest on capital is credited to 18,000. The notable situation is here the profit available is only 18,000 and interest on capital commitment for the firm is also 18,000. So here there is nothing to share. Either the partners don't have a loss nor they don't have a profit to get as a share. So we don't have any further journal entries for the case 6. Okay students, let us continue few more problems in our part 3 video. Your like, share, comment and subscription to the channel may encourage me to post more sequential videos in accountancy and other subjects. Thanks for watching.